Good morning, dear students. Welcome to the home mentoring session of accountancy. Myself, CSK Khanna from the SD Vidya School, Ambala, Kent. Dear students, we were continuing the topic of issue of shares. And in our previous class, I had shared you with very important aspect relating to the allotment of shares under the different situations. Let's recall the previous aspects what we had did with reference to the allotment of shares. I share with you that there may be the three situations. First, it is the issue may be fully subscribed, which means whatever number of shares are offered or issued by the company, same number of the applications be received by the company. So in that case, there would not be any problem relating to the allotment of share. Second situation is there when there is under subscription. Under subscription is a situation when the number of shares issued by the company or offered by the company to the general public, and the general public had applied for the less number of shares. So this is the situation of under subscription. Again, in case of the under subscription, if it qualifies to the basic condition of minimum subscription, company does not had any problem in the allotment of the shares and it can make the full allotment. Now a very important case comes which is called as the oversubscription. Students, please understand that oversubscription is a situation when the number of shares applied by the general public is more than what the company is offering to the public. For example, company has issued 5,000 shares of rupees 100 face value at par and public had applied say for 10,000 shares. Now when this situation is, it is called the situation of oversubscription. A very important question arises that how the allotment is made in case of the oversubscription. Now in case of the oversubscription, company had basically three important alternatives or options through which it can make the allotment to the prospective share applicants. Now which three options are there? Now first we understand those three important options, and we also understand that how the application money received by the company will be adjusted and to be used for this. So first condition is there that excess applications are refused and money received on excess application is returned to the applicants. Now this is a situation, as I had just cited you an example, that company had offered 5,000 shares and public has made the applications for 10,000 shares. Now in this case, company outrightly at the beginning reject the 5,000 surplus applications. Now the application left out with the company is 5,000 and the shares offered by the company is 5,000. So it can make the full allotment to all the remaining applicants. And simultaneously, at the time of application itself, company can refund the surplus application money of the 5,000 investors who had applied to the company for the purchase or subscription of the shares. So this is the first situation when all the excess applications being rejected by the company and the application money received against those applications will be refunded immediately at the time of the application. Now what could be the journal entries? See very simply here. First entry will be bank account debit to share application account for receipt of the total application money. Next entry will be share application account debit to share capital. It is with the amount which actually required on the issued share, and to bank account means the refund or return of the money of the surplus applicants. So here this way the first option is exercised by the companies. Now let's understand this with the help of an example. Here see, share issued 10,000 at the rate of rupees 10 per share and money received for 12,000 shares. Amount is payable rupees 2 on applicants, rupees 5 on allotment, 3 on first and final call. Now how the amount will be refunded? First of all, we have to say how many shares are issued? 10,000. money received for how many shares? 12,000. So on 2,000 shares, company has received the surplus application money, and the rate of application money is rupees 2 on application. So company has received rupees 4,000 as the surplus application money, and it will be returned or refunded by the company. So the first entry will be as usual, bank account happy to share application account. This is with rupees 24,000 because the general public has subscribed for how many shares? General public has subscribed for 12,000 shares. So 12,000 at the rate of rupees 2, 24,000 will be received by the company at the time of application in the bank. Now out of this 24,000, company's capital of at the application stage is only 20,000. See here that the 10,000 shares at the rate of rupees 2. So 20,000 is the share application money, which is a part of share capital account. So 2,000 shares at the rate of rupees 2 per share, that rupees 4,000 will be refunded. So the bank account will be credited. Here the entry will be very simple. Bank account happy to share application account with 24,000 shares. Next entry will be share application account 24,000 to share capital 10,000 into 2 rupees 20,000 to bank account on 2,000 surplus applicants at the rate of rupees 2, rupees 4,000 being refunded. So this way the surplus application money will be refunded to the applicants, and the full allotment is to be made to the remaining applicants. Now when 2,000 shares applications being rejected, automatically how many applications will left out? 10,000. Shares issued by the companies 10,000. So automatically now company does not had any problem. Company may make the full allotment to all the application. This is the one simple option which is called at the, that is the rejection of all the surplus applications and making full allotment to the remaining one. I will continue in the next video with the next alternative relating to the allotment of shares in case of oversubscription.